Welcome to Voice Daily Finance, the most important news personalized for you every day. Supported by Voice.com.
After listening to today's news, you'll know first, Trump's $200 billion mortgage bond purchase ignites a direct policy war with the Federal Reserve's tightening strategy. So we'll discuss why this unprecedented conflict challenges central bank independence and what it means for the US dollar and bond market stability. Second, Exxon calls post-Maduro Venezuela uninvestable, while rival Chevron accelerates production, sparking a race for the nation's massive oil reserves. We'll explore how this corporate showdown could reshape global energy markets and challenge China's long-standing oil for loans diplomacy in the region. Third, the AI boom triggers a 55% price surge in high bandwidth memory, creating a supercycle for chipmakers and an inflation tax on consumer electronics. We'll analyse why this supply crunch is creating unprecedented pricing power for chipmakers and how it will directly impact upcoming PC and smartphone prices. The Trump administration just launched a direct challenge to the Federal Reserve. In a stunning move to address the housing affordability crisis, President Donald Trump has ordered a massive $200 billion bond buying operation. The targets are mortgage-backed securities, the same assets. The Fed is actively trying to get off its books. So the thing is, the Federal Reserve's policy is called quantitative tightening, or QT. For the past 2 years, the Fed has been letting these mortgage bonds mature without buying new ones. The goal is to shrink its massive balance sheet, which reduces the money supply and helps push interest rates up to fight inflation. This is the Fed's main tool for cooling down an overheated economy. This means the administration's move is a direct confrontation with the central bank's core strategy. But this isn't a simple stimulus, it's a direct countermaneuver. According to US Treasury Secretary Scott Bessent, the entire goal is to offset the Federal Reserve's own policy. The Fed is currently shedding about $15 billion of these securities from its balance sheet every single month, a move that keeps upward pressure on mortgage rates. This creates a fundamental policy conflict. Imagine the Fed is trying to drain a swimming pool to cool it down, and the White House starts pouring water back in with a fire hose. This policy incoherence can be confusing for global markets. For international investors, including central banks like the People's Bank of China, the predictability of US economic policy is crucial. When the administration and the central bank are openly working against each other, it can reduce confidence in US assets like agency bonds and potentially affect the US dollar's stability. Now, the administration's pushing back. In an interview, Bessent confirmed the strategy, stating the administration's idea is to roughly match the Fed, which has been pushing the other way. This is a high-stakes tug-of-war with the American housing market caught in the middle. The Fed has been shrinking its more than $2 trillion mortgage bond portfolio for over 2 years, while the average 30-year mortgage rate has fallen from nearly 8% to around 6.2%. It remains far above the 3% levels seen during the pandemic. The White House is now intervening directly to try and force borrowing costs down. The key question here is whether this will even solve the housing crisis. Many economists argue that the root cause of unaffordability isn't just high mortgage rates. The bigger problem is a severe shortage of housing supply driven by restrictive zoning laws and a lack of new construction. So, while lowering rates might help some buyers in the short term, it doesn't fix the fundamental supply-demand imbalance. The mechanism is unprecedented. The order directs the Federal Housing Finance Agency to have mortgage giants Fannie Mae and Freddie Mac purchase $200 billion of their own bonds using their own balance sheets. These are the two firms that came into, government ownership during the 2008 financial crisis. What's really striking is how this solidifies the role of Fannie Mae and Freddie Mac as permanent policy tools of the government. After being rescued in 2008, the long-term goal was to eventually return them to the private sector. By directing them to make politically motivated asset purchases, the administration is treating them like off-balance sheet government agencies. This increases what's known as moral hazard, the belief that the government will always bail them out, which can deter the private capital needed for a healthy, self-sustaining mortgage market in the long run. But that's not the whole picture. The Treasury Secretary asserts this action will not harm the firm's financial standing and could even increase their earnings. Looking ahead, we need to watch a few key things. First, will this action actually lower mortgage rates, or will the Fed's tightening pressure win out? Second, keep an eye on housing market data, not just prices, but also housing starts and inventory levels. If supply doesn't increase, affordability won't truly improve. Finally, watch foreign holdings of US debt. Any signs that major international players are getting nervous about this policy clash could have ripple effects on bond yields and the dollar. The White House is now using the very institutions rescued in the 2008 financial crisis as a tool to actively work against the nation's independent central bank, creating a direct and historic clash over economic control. From a clash over domestic economic policy, we now turn to a geopolitical showdown in the global energy market. In a pivotal development following the removal of Venezuelan President Nicolas Maduro, the world's biggest oil giants are making their moves. Exxon Mobil, whose assets were nationalized nearly 2 decades ago, says it's ready to evaluate a return. And the potential here is enormous. In the late 1990s, Venezuela was an oil superpower, producing over 3.5 million barrels per day. But due to years of underinvestment and sanctions, that figure has collapsed to under 900,000. The thing to understand is if companies like Exxon can bring that production back online, even partially, it could be a major disinflationary force. Analysts at JP Morgan estimate that with the right investment, production could hit 1.3 million barrels per day within 2 years. A few days ago, we also emphasized this isn't a light switch. Billions are needed to repair crumbling pipelines and neglected fields, which could slow the ramp. That's why we've been watching the crack spread as the near-term tell. US, Gulf Coast refineries are built for Venezuela's heavy, sour crude. So even incremental barrels can fatten margins quickly, while field-level volumes take longer. But in a hastily arranged White House meeting, Exxon CEO Darren Woods called the country currently uninvestable. He told US President Donald Trump that Exxon has had its assets seized twice before, stating, "You can imagine to re-enter a third time would require some pretty significant changes." Woods is demanding major legal reforms and security guarantees before even sending a technical team to assess the state of the assets. We previously analysed how political risk and contract sanctity would dictate the pace of any re-entry, and the latest development is that Exxon is drawing a hard line before committing even a scout team. This decision brings both a generational opportunity in their legacy fossil fuel business and comes with inherent risks. A massive long-term capital investment in Venezuela would be a huge score, but it would also signal a strategic deprioritization of their multi-billion-dollar investments in low-carbon energy transition projects. Exxon has already committed over $20 billion through 2027 to lower emissions opportunities. So it's a real dilemma, a choice between a potential fossil fuel gold mine and their stated commitment to clean energy. But while Exxon proceeds with caution, its rival Chevron is hitting the accelerator. As the only American oil major still operating in Venezuela, Chevron announced it is ready for an immediate 100% increase in oil liftings from its joint ventures. On top of that, the company plans to boost its production by 50% in the next 18 to 24 months. As we mentioned a while back, that kind of heavy barrel availability tends to show up first in refinery margins, the crack spread, so the immediate beneficiaries could be Gulf Coast refiners, while producers still face the longer, costlier rebuilding curve. However, if you zoom out, you'll see another layer of strategy at play. This American-led re-entry is a direct challenge to China's oil for loans diplomacy in the region. For years, China was Venezuela's primary financial backer, providing nearly $60 billion in loans to be repaid with oil shipments. However, as Venezuela's economy faltered, Chinese lending dried up, with no new loans reported since 2017. A while back, we flagged how a US push would directly test Beijing's energy security strategy, and today's moves make that contest explicit. This created a vacuum that US firms are now rushing to fill, potentially forcing a restructuring of Venezuela's massive debt to China and establishing a US-centric sphere of influence in Latin America's energy landscape. Continuing our last discussion on the producer landscape, Venezuela's heavy crude competes head-to-head with grades from Saudi Arabia and Russia. A faster-than-expected comeback would stress OPEC plus quota discipline and risk a market share skirmish, though, again, the sheer repair bill argues against an overnight flood that would trigger price war fears. This isn't just about future oil. It's about a massive pile of past debt. Venezuela owes over $13 billion to Exxon and ConocoPhillips for those past expropriations. Conoco's CEO told the meeting that the state oil company, PDVSA, may need a complete restructuring and that banks must be involved to deliver the billions needed just for repairs. That aligns with what we've noted before. Export credit agencies and banks are the real accelerants that can pull forward timelines. This is where the situation takes a more complex turn, potentially opening the door for a new model of stabilising a failed petrostate. When the CEO mentions involving banks, he's likely thinking of institutions like the US Export-Import Bank, or EXIM. This is America's official export credit agency, which has a history of financing massive energy projects, like a recent $500 million deal in Bahrain. Its involvement could be the key to unlocking the billions needed for Venezuela's recovery. And the response from the White House? US. President Donald Trump told the Conoco CEO, "You'll get a lot of your money back," but then added he envisions starting with an even plate and not looking at what people lost in the past. We previously highlighted his send in the oil companies to fix the infrastructure language. Today's even plate framing goes a step further by signalling that new capital could be prioritised over old claims. Now, get this, that even plate comment could be the real game changer here. If the US government helps broker a deal where new investments are prioritised over old creditor claims, it could completely reprice risk for investors globally. It would send a signal to capital markets that expropriation risk in other resource-rich but politically unstable nations might be lower than previously thought. This could unlock a wave of new investment into emerging markets, fundamentally altering global supply chains for energy and critical minerals. The stage is now set for a monumental clash between corporate history and political will over billions in assets and the future of one of the world's largest oil reserves. What happens next in Venezuela won't just stay in Venezuela. Key things to watch are the official investment plans from Exxon and Chevron, any announcements from the US Exim Bank, and the reaction from China regarding its outstanding loans. Also, keep an eye on Gulf Coast crack spreads, refiner versus producer performance, and any OPEC Plus signals about quota discipline. These will be early tells on how quickly barrels actually hit the market. This information is based on market reports and is not investment advice. The energy sector is subject to rapid changes and volatility. Speaking of resources that power the global economy, a new oil rush is happening right now in the tech world, and it's creating a massive supply shock. The most unexpected news in the finance world today has to be this. The price of a critical component inside nearly every electronic device is set to jump by an unprecedented 50 to 55% this quarter alone. We're talking about a special type of memory called high bandwidth memory, or HBM. It's the secret sauce that makes high-powered AI possible because it involves stacking multiple memory chips vertically, like a tiny skyscraper, allowing for incredibly fast data transfer. The culprit is the AI gold rush. Tech giants like Nvidia, AMD, and Google are demanding so much specialized high-bandwidth memory for their AI chips that a global shortage has erupted, and they are first in line for what's available. The heart of the issue is this trade-off. For every 1 bit of this high-performance AI memory that companies like Micron make, they must sacrifice making 3 bits of conventional memory for laptops and phones. The critical point is that as memory manufacturers shift their production lines to the more profitable HBM, the supply of everything else gets squeezed. The ripple effect, an inflation tax on all other electronics. Respected industry analysts at TrendForce are now forecasting that the contract price for the conventional memory used in PCs and servers will surge by 55 to 60% this quarter alone. At the same time, the price for the flash memory in your smartphone is expected to jump by 33 to 38%. For the memory makers, it's a bonanza. Interestingly enough, this market is an oligopoly dominated by just 3 players, Micron, Samsung, and SK Hynix. They are now entering what analysts are calling a pricing supercycle. And what makes this boom different is that, unlike past cycles driven by PCs or phones where consumers might delay a purchase, the demand from AI and cloud companies is considered inelastic. They need this memory to run their data centers, and they're willing to pay almost any price. This creates unprecedented pricing power and a durable period of high profits. That's why Micron stock has soared 247% over the past year. Samsung expects its operating profit to nearly triple, and the situation is so extreme that one major supplier, SK Hynix, has already sold its entire production capacity for the year 2026. But the shockwave is now hitting consumers. Dell's chief operating officer stated, "I don't see how this will not make its way into the customer base." To put it in perspective, One tech chief noted that the same computer memory he bought for about $300 a few months ago would now cost nearly $3,000. It's no surprise then that major PC makers like Acer and Asus have already publicly announced plans to pass on these rising memory costs to consumers, following similar moves from Lenovo, HP, and Dell. So the next laptop or smartphone you buy is almost certain to be more expensive or have less memory for the same price. This crisis is exposing a fundamental bottleneck in technology, often called the memory wall. For decades, the focus was on making processors faster. But now we've hit a point where the processor is so fast that it's constantly waiting for the memory to feed it data. It's like having a world champion speed eater who has to wait for someone to slowly bring them one hot dog at a time. The bottleneck is no longer the processor's computing power, but the speed of data access. That's why even the world's most powerful AI processors are spending more time twiddling their thumbs, waiting for data, than actually computing. And relief is not coming anytime soon. New factories are years away from production. After all, building these advanced facilities, or fabs, is an incredibly complex and expensive process. Many of these new factories, like the ones Micron is planning in the US, are part of a larger strategic effort backed by government initiatives like the CHIPS Act. The goal is to enhance tech sovereignty and de-risk supply chains that have historically been concentrated in East Asia. This is a pivotal test of industrial policy, but these long-term strategic shifts take years to come to fruition, meaning there's no quick fix for the current shortage. As Micron's business chief bluntly stated, for now, we're sold out for 2026. So, what's next? Well, this extreme cost and scarcity is a massive incentive for the industry to find a way around the bottleneck. One thing to keep an eye on is called Compute Express Link, or CXL. It's an open standard that could allow systems to use larger pools of cheaper, more conventional memory, bypassing the HBM logjam. This could create an opening for new companies and new architectures to challenge the current hardware landscape. While the short-term outlook is tight, the long-term race to solve the memory wall is just getting started. All market data is subject to change. This report is for informational purposes only and is not investment advice.
That's it for today on Voice Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.